Our team is Elf Shoes. We competed in Industry 4. Our Chief Executive Officer is Josh Grossman. Our Chief Financial Officer is Callie Markey. The Chief Marketing Officer is Alex Hughes and the Chief Operating Officer is Benjamin Kitto. Our initial strategy was well thought out. Elf Shoes planned to enter North America and Europe, Africa to sell shoes in both the wholesale and private label markets. Our strategy was to differentiate our shoes through offerings a wide variety of models with mid-level quality. We also planned to raise the brand recognition of our shoes by purchasing celebrity endorsements. We expected our rivals to focus on a cost leadership strategy in all 4 geographic regions. The chief risk we anticipated is that our strategy will not be unique and our margins will suffer. Our team decided to have a contingency plan to change to a cost leadership position mid-game if our initial strategy proved unsuccessful. Elf Shoes' initial corporate strategy was to enter markets that had high potential value, which we identified as Asia and North America. These choices were made without considering incumbency because with all companies starting from the same initial position it would be irrelevant. Our company decided to avoid the markets with low value and to not plan on exiting markets ahead of time because that would likely not create value for shareholders. Elf Shoes forecasted the expected cumulative revenues and expected cumulative profits over the 6-year time period. The forecasts were $1.9 billion and $0.5 billion respectively. The actual cumulative revenues and cumulative profits were $2.1 billion and $0.4 billion respectively. Our forecast underestimated revenues and overshot profits. Our team expected our margins to be much stronger than was realized. We expected profit margin to be 26.3% and realized profit margins were 7.6 percentage points lower at 18.7%. Elf Shoes had a consistent strategy through years 11 to 15 that resulted in a relatively high stock price. In the internet and wholesale segments, our company had strong advertising and celebrity appeal as well as S&Q rating and model availability. In private label, our shoes had a strong S&Q rating. Our decision to avoid North America in this segment was a good decision as well. This chart shows our performance over the 6-year time period in the North American segment. As you can see, the blue line shows that we increased our S&Q rating in year 12 to 7 stars and then kept that rating through the end of year 16. This chart shows our market share in the North American region. In the wholesale and internet segments, our market share fluctuated between 5% and 12%. We initially entered private label in year 10, subsequently withdrew, and then re-entered private label in year 16 in anticipation of competitor actions. In Europe and Africa, our S&Q rating started at 5 in year 10, increased to 7 in year 13 and remained flat through the end of year 16. In terms of market share, our company focused on the private label market in the Europe-Africa region. Our company had 8.3% market share in year 10, which steadily increased with a high of 57% in year 14. We did maintain a presence in the internet and wholesale markets, but with market shares below 15%. In the Asian Pacific market, our S&Q began at 5 in year 10 and then increased to 7 in year 13. Our market share in private label shoes in the Asian Pacific market was particularly dominant in years 14 and 15 with 72% and 100% respectively. We also maintained market shares of approximately 10 to 15% in the wholesale and internet segments. In Latin America, our S&Q rating mirrored our performance in the other regions, beginning at 5, rising to 7 and remaining at 7. The Latin American market was not a focus in any of the segments, remained below 15%. The celebrities Elf Shoes chose to represent our brand were Jose Montana and Kobayashi Jones. We paid $3.1 million for a 3-year contract with Jose and paid $3.1 million for a 4-year contract with Kobayashi. The factors that led to tempered financial performance were unexpected competitor behavior, lower than expected margins, and resistance to in-game changes. Other companies, chose to implement end-game strategies that significantly hurt our previously stellar financial performance. Our company did try to mitigate those endgame tactics by spreading private label across the geographic regions in year 16, but stock price still dropped dramatically. If our company were to continue to operate, we would be less resistant to tweaking our strategy. We would take lessons from other successful companies and attempt to implement them in our company. In conclusion, e.l.f. Shoes had strong financial performance from the year 11 to year 15. Our company struggled with competitors' actions in the final year. However, our team feels that our strategy was sound and realistically implementable.
What is the most inspiring thing I ever said to you?
Don't be an idiot. Changed my life.
Whenever I'm about to do something, I think, would an idiot do that? And if they would, I do not do that thing.